I think that we are coming into a period of greatly diminished liquidity. Capital markets are beginning to freeze. Counterparties don't trust each other. We watched this happen in 2008. I'm not suggesting it's going to get that bad. But the other thing is that I think the upside rally exhausted itself. The year 2025 was one of the best years on record for the gold price increase, and I think we ran out of buyers for a while. Something else happened, Lucian, which is that perversely, the war generated a circumstance where the US dollar prospered.
The global capital markets are entering a precarious phase of diminishing liquidity, where counterparty trust is beginning to freeze in a manner reminiscent of the 2008 financial crisis. After 2025 marked one of the best years on record for gold price appreciation, the market appears to have reached a point of temporary exhaustion as the initial wave of buyers becomes saturated. RickRule, a legendary natural resource investor and founder of Rule Investment Media, notes that we are currently witnessing a perverse market reaction where geopolitical conflict has temporarily bolstered the US dollar. He emphasizes that while the dollar has prospered as a safe haven during the recent hostilities, the underlying structural issues in the financial system remain unresolved. Data indicates that the gold bull market of 2025 saw a staggering 30% annualized gain, leading to a natural consolidation phase. However, as capital markets tighten and the giant sucking sound of physical inventory drain continues from global exchanges, the move toward hard assets is far from over. This period of diminished liquidity often precedes a massive rotation of capital once the dollar's temporary strength wanes, and investors realize that paper promises cannot replace physical reality in a frozen credit market. Now, we present the clips from RickRule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
For the Turks, gold served its purpose. Gold is the ultimate liquidity. So I can assume at the outset that the Turks needed the money for some reason. Because the Turkish central bank has saved in gold, for some time they had access to the money. You know, one wouldn't describe Turkey for the last 20 years as being fiscally particularly well run. And I'm fairly certain that if the Turks went into international bond markets to sell lira-denominated bonds, they would have a very difficult time raising money, given their track record managing the lira. The fact that the Turks saved in gold and had access to the liquidity at this point in time, despite the overall mismanagement of their currency and their economy, says a lot about gold. Says something about the Turks, too, but it says a lot about gold. I think people need to realize this. I see this discussion, Lucian, on the internet about the catastrophic decline in the gold price. Really? What's your time frame?
Yeah.
I began saving in gold religiously in the year 2000. Gold was at $250 an ounce. When I look at the current gold price and people tell me the gold's down, I sort of shake my head. Yes, I understand if you got high-sided in gold. If you waited until 5,000 or 5,100 US to buy it, you're disappointed. It's interesting, we can talk about it later in the interviews, that people line up to buy gold at 5,200 and then panic out of it at 4,500. Manic depressive behavior, and the type of behavior evidenced by other people that's been responsible for a fair bit of the money I have now. One is supposed to buy low and sell high, and people are exhibiting different behavior. Not to say the Turks did. You know, the Turks have been consistent buyers of gold for 10 or 12 years, and I assume they did, assuming that the reports are correct, that the Turkish central bank sold the gold, they did fairly well on it. And I would assume that they sold it for the most obvious of all reasons, which is to say they needed the money. I think that we are coming into a period of greatly diminished liquidity. Capital markets are beginning to freeze. Counterparties don't trust each other. We watched this happen in 2008. I'm not suggesting it's going to get that bad. But the other thing is that I think the upside rally exhausted itself. The year 2025 was one of the best years on record for the gold price increase, and I think we ran out of buyers for a while. Something else happened, Lucian, which is that perversely, the war generated a circumstance where the US dollar prospered. The DXY, the exchange-traded product that measures the dollar versus other currencies, has been soaring. And US long-term interest rates, despite Mr. Trump's best efforts to bring them down, have gone up. That higher yield relative to other countries' currencies, in particular the euro, has meant that the U.S. dollar has been relatively attractive. So the U.S. dollar gold price has declined, both because we ran out of buyers. We had some, I suspect, liquidity-driven sellers, countries in particular that had no current access to credit markets, and the fact that perversely the U.S. dollar became stronger during the war. I would point out, Lucian, and we have talked about this in prior interviews, that major cyclical declines can occur in secular bull markets without derailing the market. In the period 1970 to 1980, which I remember well, a period for reference that saw the gold price go from 35 US dollars an ounce to $850 US an ounce, a 20-something fold increase. There were at least 4 instances in that decade where the gold price fell by 25% or more. There was one in 1975 where, if my memory serves me correctly, the gold price fell by 50% without derailing the gold bull market. So what we have seen very recently is completely consistent with gold market behavior in bull or bear markets. What it has done is unnerved the recent fans of gold.
The Turkish central bank's recent utilization of gold reserves highlights the asset's primary role as ultimate liquidity. Despite years of fiscal mismanagement and a devaluing lira, gold provided Turkey with immediate access to capital when international bond markets were effectively closed to them. This saving in gold strategy allowed for a critical lifeline during a period of frozen capital markets and diminishing counterparty trust, proving that gold remains the premier insurance policy for sovereign entities. While the recent decline from the $5,200 highs has unnerved new investors, historical context reveals this is standard behavior within a secular bull market. During the 1970s, gold underwent a 20-fold increase despite 4 separate instances where the price fell by 25% or more, including a massive 50% correction in 1975. The current pullback is a combination of a soaring US dollar index, DXY, and a natural exhaustion of buyers after a record-breaking 2025. For those who began saving in the year 2000 at $250 an ounce, the current catastrophic decline is merely a cyclical correction that flushes out speculative leverage while reinforcing gold's status as a necessary lifeboat in a fractured global economy. Let's get back to the interview.
My physical silver occupied a portion of my speculative portfolio. And it's important to note that I own gold probably for the same reason the Turkish central bank did. I owned it as a store of value, as insurance. I save in gold. I maintain liquidity in US dollars. Silver was very, very different. I owned it as a speculation. I owned it because it was hated. When you and I first began to interview, the silver price was about $20. And if you read speculator comments online about silver, they were either people who got shaken out of the silver squeeze and hated it, or at the very best, they were bored by it. And I felt 2 things. I felt that when the hate dissipated, that the price would go up all by itself. But I also felt, and expressed on your show, that in prior precious metals bull markets, after the momentum in gold attracted generalist participants, that silver would begin to outpace gold. Both of those occurred. When the hatred went away, my reason to own silver went away. And when it went away, I had to ask myself, is silver the best place to express my speculative technique? And the answer became no. Paradoxically, the silver stocks became better speculations than silver itself. If I sold my silver and transferred the money into silver stocks, if the silver price continued to go up, the silver stocks would express that. Ironically, if silver traded sideways, the silver stocks were priced in the market to discount $45 silver. So the better silver stocks could go up even if the silver price didn't go up, because their cash flows would escalate. And ironically, if the silver price went down, because the cash flows of the companies were estimated at $45 rather than $75 silver, I could expect to lose less value in the silver stocks than in silver itself. So confronted with that circumstance, and understanding that silver was in the speculative part of my portfolio, I decided to exit the silver, pay the capital gains tax. And by the way, I exited 80% of my silver, not all of my silver, and redeploy the capital into assets that were more suited to the market conditions of the time. There are some fairly high quality gold juniors that have some risk left that, if they're successful, as I hope they will be over the next 5 years, will be taken over. And they are uniformly off 40%, 45% in price in the last 2 months. So I'm on the bid. Before that, before the Persian Gulf, I was on the bid for 5 or 6, I think it's 6, microcap oil companies involved in conventional exploration offshore in frontier markets. The increase in oil prices as a consequence of the Persian Gulf conflict has made those companies beyond my reach. The prices escalated as a consequence of the oil price quote, so I'm not able to buy those anymore. So where I'm really on the bid right now is a fairly select group of junior gold companies. If the conflagration in the Gulf continues, and if, as a consequence of that, we see a more synchronized global recession, and hence a major sell-off in global equities, if we see economic weakness make the copper price go down, as an example, I'll be a broad-based buyer. And if I do that, I'll go back to the best of the best. If we were to see, and I'm not saying we will, but if we were to see a 50% decline in general equities prices as a consequence of an economic slowdown, you'd see me buying Franco, buying Wheaton, buying BHP, buying Glencore, buying Rio, buying Anglotech. I'd buy the 10 or 12 lowest cost, most muscular commodity producers worldwide. And that would likely be, I'm 73 years of age, the last major trade of my life. I would suspect if I got a 50% off sale in a sector that I think will enjoy 300% price escalations over 10 years, if I could lock myself in a 5 or 6 bagger, a fairly certain 5 or 6 bagger for 10 years,
Of course.
What else do I need to do? I mean, Lucian, I promise I'll still be conducting interviews like this until they carry me out dead. But in terms of deploying my own capital, that would probably be all I'd need to do. There are a couple of explorers, pre-development companies, that look to me like they have 10 million ounce plus discoveries, and their share prices have been cut in half. Their deposits didn't get cut in half.
Yeah.
So there are those. If I'm right, if these are 10 million ounce deposits, they will be taken over, and they'll be taken over for eye-popping multiples. There are some developers that are selling at 30 or 40% of net asset value. Now, I think that the discount to net asset value will go away as time goes on because you're closer to production, right?
Yeah.
And then there are some producing companies, both single asset producers and multi-asset producers, where if their share prices don't increase, they'll be taken over by majors. Before I buy any company in today's climate, in today's sell-off, what I'm looking for is a company that is strategic as an acquisition to a bigger company, where either the share price increases organically because of markets or they get taken over. I'm looking in every case at assets that are strategic to somebody.
The current market correction has created a rare opening for disciplined speculators to rotate out of momentum-driven physical positions and into high-leverage equities. While silver served its role as a hated, undervalued play at $20, the recent surge towards $75 signaled a point of speculative exhaustion, prompting a strategic shift into silver stocks and gold juniors. These equities offer a unique risk-reward profile, as many high-quality silver producers are currently priced to discount $45 silver, providing a significant margin of safety and the potential for cash flow escalation even if the metal trades sideways. For those with a long-term horizon, the focus has shifted toward identifying strategic assets that are prime targets for acquisition by major producers. If a synchronized global recession triggers a broader equity sell-off, it will be the ultimate 50% off sale for a sector poised for 300% price escalations over the next decade. Positioned correctly in low-cost producers like Franco-Nevada or Wheaton Precious Metals, investors can lock in a potential 5 to 6 bagger as the monetary era resets. Securing these strategic undervalued assets today is the key to preserving and growing wealth through the final stages of this secular bull market. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.